risk, you have to hedge against risk.
Yes.
What happens if we do an inverse correlation of yield and S&P?
Well, it's certainly something the market has not had to grapple with for quite a long time. And, these correlation regimes can last years. The pre-crisis period, you have to go back to really the 1990s where you had the old days when a Fed tightening cycle, higher rates, was the signal that stock prices would fall, right? So rates up, stock prices down. And then in this risk on, risk off phase, we had a period where the inverse correlation was very dominant. And so what's the impact on a portfolio? Well, as you mentioned earlier, most people have some blend of a 60-40 or maybe 70-30 stock bond exposure, right? These things tend to de-risk each other when the correlation is negative. When the correlation changes, the overall volatility of the portfolio can change quite dramatically. So right now we're in one of these testing phases where the market is grappling with, are we comfortable, risk assets, are we comfortable with higher yields as a reflection of a stronger, more robust economy? That's okay. Or are higher yields the sort of sell signal because you have to discount earnings at higher prices? Right. It reminds me a little bit of what we grappled with in January. The precursor to the VIX meltdown in February was the same dynamic we're experiencing right now. So the market's being tested right now. We'll see. Some would argue that the sell-off in rates or higher yields is past us, but it's something definitely to really keep a close eye on.